Hey guys, what's going on? So today I just want to talk about a really great business that I think can double or potentially even more in the next couple years, 3 to 5 years plus, maybe even sooner. I think it's just a really good investment and there's really a good business case behind this. So let's just go over the basics, what this company is, what it does very briefly, and I'll go over the numbers for you and kind of give you my substantiation for this. So the business is Ulta Beauty, and they're a skincare, cosmetic, fragrance, all that whole gist of things. And they have their own line of products too. They're basically everywhere in the States. They got stores in 48 states, basically everywhere, and they have a loyal cult following of customers. Approximately 95% of the sales that they have, those people are already Ulta Beauty members. So I was reading online, talking to different girls, and they say that they got a really good points program, and everyone just loves joining the loyalty program. It's great. So one of the differentiating factors between, you might ask, like a Ulta Beauty and say a Sephora or like one of those beauty little spots inside of like a Walmart or like a JCPenney, that sort of thing, is that they have an Ulta salon, which a lot of women have said that it's a very good salon. There's a lot of really good reviews online for that. And that was about 4% of their sales, which is pretty good considering the inflationary environment right now that we're having. That was for fiscal year 2023. So a lot of people have said positive things about that. And it looks like that, they have lower tier, mid tier, also higher tier kind of products, unlike maybe somewhere like Sephora or some other places where if you go in the store, stuff there is just super pricey, and not everyone, especially right now when people have less discretionary income, want to buy those items. Just taking a look at the market for this, so there's a $112 billion market in the US for this, and it's growing with a pretty decent CAGR every single year. So this market is just getting bigger and bigger. People want to look good. They're always going to spend money on their appearance, and this is just going to keep growing. And another moat that they have is that they're going to be opening in Mexico in 2025. That's going to be naturally higher margin because if they're making this stuff over there, it'll be a little bit cheaper. They haven't even touched Canada yet, and they were talking about maybe in Canada soon. So there's a lot of business opportunity yet. So this is a very big growing company. Okay. Now let's look at kind of some of the numbers on what's going on here and maybe why they're not doing too great right now. So if we take a look at Ulta Beauty, the list, the 13 weeks ended, if we compare it to the last year, their sales are up really only around 3%. So they raised this fiscal year 2024. The stock has been getting pounded because they've been kind of saying, hey, this year's going to be more flat, single-digit revenue growth. It's not going to be as great. Like I was mentioning before, people are buying the more basic cosmetic items, and they're not buying super expensive stuff, which the margins naturally are way better, right? So this year is just going to be really slow growth, stagnant, and show you, but stock in the near term has been getting punished very heavily for that. So, Ulta Beauty is growing great, and they came out with this press release, the Q1 came out, and the stock has been getting punished inappropriately, in my opinion, for this. So right now, if I take over the financials, basically the revenue growth, from 2021, we had 40.3% revenue growth. That was right after COVID, where all the stores closed and everyone started buying stuff online like crazy. People had a ton of money. So that's when they were growing like crazy. And ever since then, it was still growing pretty fast, but it slowed down because, 2021 and 2022 were just crazy times for all companies. They were growing 30-40% plus. So last year, 9.8%, and then this year is going to be more like low single digits flat. And that's just the nature of having higher interest rates, right? People aren't going to buy the super $100 to $200 like Sephora type items. They're going to be buying cheaper stuff, but they're still buying stuff. They're still growing slightly. But the thing is it's more of the lower end products. So this company is not going anywhere, and this is just a blip in my opinion until interest rates go kind of lower and people have, you know, a little bit more discretionary income. People are always going to care about their appearance, and that's kind of the main thing, right? That's kind of the main thesis you're kind of going off of here. Another interesting thing is that if you take a look at kind of the if you take a look at the PE for Ulta Beauty, the historical PE is around 17 times earnings. And remember when I said that the revenue went up 40% that one year in 2022, you know, they had a high of 21. So right now they're just under 15 times earnings, 14-ish times earnings. So basically, if you get back to 17, 18 times earning, which is the mean, which is no problem, if they start growing a little bit more, the only reason they're trading, you know, under the mean right now is because they said flat. So that's why the stock is getting overtly punished, in my opinion. So once we get back to 17 and 18 times earning, you're going to have a multiple expansion. The stock's going to appreciate pretty heavily just based on that, you know, and that's, you know, very base case, very easy thing to happen, right? The other thesis is that, you know, people start getting a little more discretionary income, and they're gonna, you know, their revenue growth is, if you look at now, for 13 weeks, it's like what, 3-4%. If it goes back to 8 to 10%, low teens, you know, that's very positive, you know. So let's say even on the low end, if you get 7 to 8, high end, you know, 12. That's pretty good CAGR on its own, right? So on the low end, let's say you have 7%, and then also they're making about $1 billion of free cash flow every year, okay? And they have like 600 million in cash, and they don't really have any long-term debt at all. So basically, majority of this free cash flow, you know, is going straight to share repurchases, okay? So if we go back to the balance sheet, you know, if you see last year in April, they had 50.1, you know, I think that's, yeah, so these are in thousands, you know. So they bought back around 4%, 5% of their shares outstanding. So let's say, you know, they're buying back, if they spend like 800 out of the billion, 800 million out of the billion on share repurchases, they're buying like 4 or 5% of their float every year. So on the low end, you're getting 8% from revenue growth, okay? That's when the rates get a little better. People have a little more discretionary income. You're getting 7 to 8% plus 4 to 5%. So at a minimum, you're getting around 12 to 13% compounded on your money every single year. That's without any multiple expansion. You know, that's if the PE stays at 15, right? So you're getting a minimum of 13, 14%, all the way to 20% if the revenue growth is like in the low teens, okay? Plus like the 4 or 5% from free cash flow to share repurchases. And then you have a possible multiple expansion because the PE might go back 17, 18 when the revenue growth starts going back up, or when, you know, the gap EPS starts getting a lot better because they start purchasing shares again. So in my opinion, this stock really is a no-brainer. It's super cheap right now. It's just dirt cheap in my opinion. And I think, you know, this is a fairly straightforward double. The next couple of years, I really think it'll happen. So yeah, this is not financial advice, guys. This is just my opinion. Read the presentation, read the investor relations, and make up your own decision. But I just think it's a really good investment. See you later, guys.